Continuing our discussion of how inflation redistributes wealth, let's look at these two equations that we've worked with so far, that the actual rate of return is equal to the nominal interest rate or nominal rate of return minus the actual inflation rate, and the Fisher effect, that the nominal interest rate is equal to the expected inflation rate plus the equilibrium rate of return. When you substitute one into the other, you get that the actual rate of return equals the difference between the expected rate of inflation rate and the actual inflation rate plus the equilibrium rate of interest, real rate of interest. It's summarized in this table, which is a really important table to focus on. If the expected inflation rate is below the actual inflation rate, that means that you thought inflation, for example, was going to be 2%, but it turned out to be 3%. Inflation was higher than expected. Then the real rate of return is going to be less than what you had desired if you're a lender. You had lent on the basis of, you were thinking 2% inflation, so you set an interest rate accordingly, but inflation turned out to be 3%. If you would have expected it to be 3%, you would have set an interest rate a percentage point higher. Unexpected disinflation, and disinflation means that inflation is falling. That means that the expected rate of inflation is greater than the actual rate of inflation. You thought inflation was going to be 2%. It turned out to only be 1%. In that case, the real rate of return is going to be greater than the equilibrium rate, and lenders will have benefited, and borrowers will be paying back more money in real terms than they had actually anticipated. So both of these columns involve either the lender or the borrower ex post being unhappy with the deal that was cut. Only when the loan contract was signed. Only in this instance, when expected inflation is exactly equal to actual inflation, is there no redistribution of wealth, and the lender and the borrower ex post say, yeah, that's a contract I would have signed ex ante. So this is explaining how inflation redistributes wealth among borrowers and lenders. Lenders prefer low inflation, and borrowers would benefit from higher inflation than expected. When governments pay off their debts by printing money, it's called monetizing the debt. If you think about it, the entire debt of the United States could be paid off because the government could simply print the money and pay back all of the bonds that are owed. Why don't they? Well, one reason is the Fisher effect. Banks will be able to realize that the government is printing money to pay their debts, and therefore they will anticipate a large increase in the money supply. That will cause nominal interest rates to go way up, particularly on government debt. There's a political cost as well. If you own a government bond and the government is paying you back with money that has less and less value, you're the lender who is being harmed by the inflation. So you're unlikely to vote for a government that engages in such an action. If inflation is moderate and stable, both lenders and borrowers can forecast well, and their loan contracts can be signed with greater confidence. When inflation is high and volatile, then loan contracts have a high degree of uncertainty, and financial intermediation or banking becomes a much more risky affair. Inflation also interacts with taxation. For example, inflation can increase tax liabilities unexpectedly. Taxes are collected on nominal capital gains, so that you may perceive that someone had a lot of capital income when in fact it was just nominal capital income high, not real capital income high. and they be pushed into a higher tax bracket. So that may discourage people from investing because they're worried that to the extent there's high inflation, their tax rates are going to go up. Lastly, inflation, once it gets going, is very hard to stop. Why? Because once inflation gets going, people tend to expect it to continue, and the government has to really clamp down on the money supply in order to change people's expectations. This happened in the early 1980s. Inflation rose to 13.5%, and really strong restrictive monetary policy reduced the rate of inflation to 3%, but in the process resulted in a very severe recession and very high unemployment. We'll be studying the effects of that monetary policy a little bit later in the course.